think we'll kick off. So thank you everyone for joining us today. For those of you who I haven't had the pleasure of meeting, my name's Samantha Woodham. I serve advisors here in New South Wales and all over in WA. And today I've got with me Matt Waitscher, who's our CIO here in Asia Pacific region. Now, I'll just get the housekeeping out of the way first because otherwise I will forget this. So first and foremost, you should have a little question and answers button at the bottom of your screen. So please put any questions in there. If we can, we'll try to incorporate it and answer them throughout the presentation, but otherwise we'll definitely address them at the end or get back to you. So please put your questions in the questions box. Second of all, here we go. Everyone's favourite slide of the day, our typical disclaimer. So obviously I'm not going to read this, but everything we say today is general advice only. And yeah, please read the slide as you see fit. Now, I wanted to get everyone here today, or I thought it'd be a great chance. Obviously, you know, we've just finished end of financial year. It's gone pretty damn fast, and it's been a wild ride for definitely the first 6 months of the year. I think this is the most extreme markets I've ever experienced personally myself. So given that, Matt, can you, I guess, just give us a bit of a summary of, you know, where we've been and where we're at the moment?
Sure, Sam, and thanks to everyone for joining. But as the slide says, this has been a roller coaster quarter for markets. So and obviously the first quarter with a sharp rally up and then down again. Big sell-off obviously in February and March, and an equally extreme rally in April and May, and to a lesser extent June. And I don't think it's over yet. From where we are now, I think there's a lot that could happen. This rally could continue on if we continue to see, you know, progress in the economic growth side. But there's also a potential for the rally to pause or even another significant sell-off if COVID numbers, infection rates continue to rise, and countries go back into lockdown. That could definitely mean that economies that have been looking reasonably good begin to stall again. So, you know, there's a lot happening under the surface in markets. You know, tech stocks have been a big driver, and we'll discuss that today. Even though their valuations are very high, I think, you know, bond yields, as you can see, haven't really provided much of an offset in the sell-off and have kind of flatlined ever since because of the central bank intervention, which we haven't seen at this sort of level ever before. And so it's a really interesting investment environment at the moment. There's some interesting investment opportunities, but I think there's some areas to avoid as well. And we'll try and discuss that today and talk about how sustainable we think this rally is and what's implied in the markets.
Yeah, absolutely. And even, you know, just looking at this, if you I heard an analogy the other day, you know, if you went into a coma, God forbid, in, you know, January, February and woke up, you know, this week and you looked at markets, you'd really have no idea that, you know, we've been on this amazing roller coaster ride or in between. So given that and given where, you know, as you can see on the slide, give or take back to where we were, maybe a little bit short, how have our portfolios performed through that time?
So we're obviously long-term investors, but given the ups and downs of the last 3 months, I thought that I'd just share our performance with everyone. So you can see that our, you know, in the blue bars here, the performance throughout March was very good relative to peers and obviously relative to the ASX 200 there. What we've seen on the way back up is the performance has been a little bit more mixed, but still we've been keeping pace there. I guess to put it into perspective, our growth real return fund and the growth SMA captured about two-thirds, 67% of the downside of the peer group. And while that's still a loss, it's really important because of what we've, I guess, been discussing with advisors over the last year or so, that power of the impact of negative compounding. And so to give you a sense, to make up for the loss in March, that 7.5% in March, our growth funds, the SMA and the real return fund, our growth strategies need to deliver about 8.4% back to make that loss back. This compares with the peer group, which lost about 11.5% it needs to actually make back 13.2% on average to wipe out those losses from March. And I think given that the rally we've had, all of the portfolios are on track to do that relatively soon if this rally continues. But I think that, as I say, there's a bit of uncertainty out there about how things move forward. I think, March wasn't a one-off. I think that what we see over the longer term is that our portfolios have outperformed over longer periods, especially the 5, 7 and 10 years. And we've done it without the drawdowns that the peer group have, the median of peers there that you see in the purple bar. And just to talk through that point again, that upside capture and upside downside capture is something that we've spoken a lot about in the past, and not compounding negative returns or large negative returns really adds to the upside potential of our portfolios. We can take less risk and still outperform the peers over the longer term, still deliver on our goals for investors' goals.
You touched on it before, and I think the number one question that I keep getting from advisors is, we've seen this massive rally back. Is this sustainable? Are we going to see another major drawdown? And obviously you mentioned, we don't know. We don't have a crystal ball. So unless you do, we probably wouldn't be sitting around this table. We'd be off on our private yacht somewhere. But thinking about that rally back, and it really has been quite incredible how quickly it's bounced back. Can you unpack that a bit for me? So, what's really driven that rally back?
Yeah, sure, Sam. So what we've seen is really over, and it's not just over the last 3 months, but over the last few years, and very much more pronounced over the last 3 months, is investors favouring the US market, and in particular, the rally is being driven by pretty much 5 or 6 stocks. The FANGs or the FANGMs: Facebook, Apple, Amazon, Google or Alphabet, Netflix and Microsoft. You can see that really clearly distilled in this slide. We think that all of those companies, and there's lots of great companies in the US, but all of these companies, they're great companies, but we think that from that fear of missing out, especially over the last 3 months, we've really seen prices become very extended in these areas. I think that we'll dig into this a little bit, but what's implied in the prices is getting to fairly extreme levels. The divergence between the rest of the world and the US is getting back to all-time extremes, and certainly the divergence between US tech and the rest of the market is at extreme levels as well, approaching levels that we've seen back in the dot-com era, if not exceeding. And as I say, that's not to say that these aren't great companies, but really what's implied in the prices is getting to extreme levels. So this is just a simple chart showing you the evolution of what's actually implied in growth rates in the underlying, in the US market and in global developed markets. And what we see is that's really started to diverge in the last little, or actually probably since 2012 that's diverged, but certainly become more pronounced over the last year in particular. And what it's showing is that the expected 10-year growth rate that's implied by the current market is actually 7.9%. Now, for the rest of the world, it's 2.7%. 7.9% isn't the most that's been implied by markets. You see areas like 2009, mid-2009, or even in 2016 that was slightly higher. But it's certainly decoupled from the rest of the world. And I'll talk a little bit now about the likelihood of that actually being achieved.
Yeah, that's definitely a number one question on my mind. Is that actually sustainable?
Yeah, Sam. So, look, maybe we can achieve that growth rate, and maybe stocks do achieve that growth rate, and the rally does continue. But really, when you look at it, it's only about a 12% chance of that actually occurring when you look at the historical data. maybe it can happen, maybe it can't. A few other things that aren't really in the favour of achieving that growth rate from here, aside from the dispersion with global stocks, is that we've never gone back to back with such a high growth rate. And over the last decade, the 2010s, you saw a 9.1% growth rate was achieved, realised by the US market. And our starting point at this point in time is also a deep recession. And not to mention other things, the amount of uncertainty that's around, obviously global pandemic, political tensions, and the rise of populism, trade wars, these sorts of things. It's not that it's not achievable, but it's just that it's becoming more and more unlikely at this point in time, or we see the probabilities are against it relative to other assets out there. When we look at it just in another way, we've done some research. Good news tends to get extrapolated by the markets, and there's no doubt some extrapolation going on in that 7.9% implied growth rate. We can see the extrapolation clearly in the data that's out there. And when we've done some analysis, when you look at, extrapolations happens on the upside and the downside. So when you look at a market implied growth rate of less than zero, so markets implying negative growth rates, the markets tend to be wrong with that as well. And there's 89% of the time markets will, or the realised growth rate will actually beat that estimate, that implied growth rate. And on the other end of the fence, every time, every time you see a growth rate that's implied that's greater than 3%, you generally 70% of the time have a miss there. So the markets aren't necessarily great at delivering on what they're implied or the expectations there. So even in the middle ground there, you see it flips around a little bit. But we'd say that with a growth rate again implied of 7.9%, we think that the chances of that being achieved, the probabilities probably aren't in our favour at this point in time. It's not to say that we can't achieve it, it's just that there's maybe better, more risk-focused opportunities out there for us.
And timely, I know we've just been talking about the US quite a bit then. Literally, I had a meeting this morning and we're talking about the FANGs. So can we pull apart that a little bit more and have a look at really just how much the FANGs have driven? Sure.
So what is really driving that implied growth rate, again, is US tech, and it's slightly more broad than that, but really when we're talking about US tech in particular, we're talking about the big stocks, the big six, and the effect that because of their size they can have on the US market. So what you see here is really, well, firstly, there's a dispersion between what the historical growth rate for the S&P 500 going back 65 odd years is at 5.2% versus what's implied by all of the stocks, the FANG stocks here on the page. And we can see that, basically what's happened is that the market is extrapolating these growth rates out, and higher growth rates tend to then lead to higher expectations for growth rates. In essence, 10-year growth rates are extrapolated out and into the future, and then they're expected to become permanent. So if on this page we're showing that Amazon has got a expected growth rate of 43%, if that was to become permanent, or even if it was to be achieved over the next 10 years, I think, mathematically that gets to the point where Amazon would be bigger than the entire retail sector, the global retail sector, that is. And so, again, it's not quite, we just don't see that that's quite feasible at this point in time. Only a handful of companies growing at over a growth rate at over 10 times of the economy, at a growth rate of 10 times the economy. Eventually, these six stocks just become the market, and it's not really mathematically possible for that to happen. We think, what we do need to see is for this rally to continue is for different market leadership to occur.
Just on this slide just for
Sure.
1 minute, because these are really quite extraordinary numbers looking at it. And I just want to clarify for myself and for everyone listening, these are the annualized numbers as well. So using Amazon, you're saying it's what the market's implying is that Amazon's going to grow by 43% year on year for 10 years. So it's really a 430% increase over that decade.
Well, and if you compound that, it's a lot
phenomenal.
more than that as well, Sam. So yeah, that's
Quite
a very big
insane.
growth rate.
But sorry to distract you from your
No, not
good
at all.
role.
So I think that just to your point, that yes, these companies, to achieve those growth rates, they would certainly remain the biggest companies in 10 years' time, but that would be out of the ordinary. What we're seeing now, we think that according to this slide, which I think is a great slide, is we're in the decade of US tech is the only place that offers growth. But if you look back, we've been in the 1980s in peak oil, where lots of oil companies were. A decade of peak oil, lots of oil companies were in the top 10. Obviously there was the Japan bubble when the top 10 largest companies in the world were basically Japanese, apart from IBM and Exxon. The tech wreck, the tech bubble, and then the last decade where China was expected to take over the world, where you see lots of oil companies and resource companies in there. We think that this is a pattern that will occur. People are extrapolating out, those growth rates that I just showed you. And that it's probably more likely that over the next 10 years that the market leadership will be different when we get to 2030. It's a pattern that's happened before as economies rebalance and growth rates are actually realised, and we see that markets do need to revert to a mean, and actually leadership needs to be much more broad-based.
So given all of that, obviously, just to recap, FANGs are great businesses but incredibly expensive. Where are we investing? Where are there opportunities at the moment?
So it won't come as any surprise that we do have small holdings in the areas that I've been discussing, and as a proportion of the portfolio, we're not heavily invested in those in the FANGs, as you say, Sam. And I think that the area, some of the country at a country level, some of the areas we like are really the UK, emerging markets, sectors like energy and financials. They're all interesting opportunities that we think investors have really avoided because they perceive a lot of risk. But what we would say is that there's actually a lot of risk already in the prices of these assets. And so some of that risk is already accounted for. For the UK, just to give you an example, we think that Brexit and COVID, in the longer term, in the short term, they may well have an effect. But we think in the longer term, some things will be different, but we think that there'll be more normality than there will be different, and cash flows will remain more normal in the future than different. That's not to say that there won't be some differences, but we think that stocks are priced for a huge amount of bad news to come, and we think actually there's probably a margin of safety in the opportunities that are presented here, relative, obviously relative to the US. I think Mexico here is another relatively new opportunity that we've been looking at. Again, it's priced for a worst case scenario, we'd say, similar to the UK. We like emerging markets overall, but emerging markets in itself is quite diverse, and we think that when you look at it as a sum of the parts, some parts have done well. China would be one of those parts that has done very well coming out of the virus, and other parts, Mexico, we think that is a better opportunity from a risk-adjusted perspective at this particular point in time. It's also got some interesting drivers. It's not all about cyclicals, and it's also got the currency benefit. We think that the currency is also undervalued there. That doesn't mean that it's not without risk, but we think it's a better bet when you're looking at it from a risk-adjusted perspective with something, say, the US. In all of these cases, we think only a small amount of good news can see a big lift in investor expectations. And when fundamentals matter again, we think that the risk return trade-off here is much better than in some of the other areas.
Well, you might, you just answered the question. I was going to say you might be reading our advisors' minds, but then I didn't want to throw that out there. But we literally just had a question saying, can you touch on Mexico? Because it's the first time we've seen it on these charts. So you answered that one for me. What does, I guess, stare out at me though is that US is 0%, and it's not so much that that it's all the way down there. I would expect that, but obviously we do have some American or US exposure. Where are we invested then in the US if as a whole it's?
Yeah, so this slide really shows that to some extent, Sam. I think that as we've discussed, US tech and to a lesser extent US healthcare, we think are overvalued at this point in time. And what this chart is showing you is a bit of that divergence. I think that the spread between value and growth stocks has surpassed the levels of the dot-com era. Some of the dispersion that we see on this slide might be, certainly the FANGs are good companies, as you say. Some of it may be structural, but we think when we sort all of these stocks into buckets based on their CAPE, their cyclically adjusted price to earnings ratios, the top quintile stocks in Q1 there are really the cheapest stocks, and the bottom quintile stocks in Q5 there are really the most expensive stocks. And the way that's played out over a very long time is that the cheapest stocks have usually delivered the better returns, and the most expensive stocks haven't. So that's how to read this chart. And as you say, it's not all about being uninvested in the US. It's just picking the areas that we like. And in that Q3 quintile 3 bucket you see there, we are invested in US energy and US financials. We're also invested in some US consumer discretionary stocks as well. Where we see the value, it's really it's really important that we're invested in those areas. Where we don't see value, the US techs and the healthcares, that's where we're trying to avoid at this point in time. I think that the market dynamics at the moment are really set up for some price, reversion in prices, some mean reversion. We think we're at really extreme levels, and we think in the assets that we own at the moment that there's enough of a margin of safety that everything doesn't have to go right for us for significant gains to occur. And we believe that all of our portfolios are really positioned to deliver on their return objectives, whilst keeping to what we always try and aim for, and that's managing that downside risk. So we're trying to. It's a difficult market to be investing in because of the dispersion in asset prices, and so we're trying to make sure we get that balance right, given the uncertainties out there. Making sure we can capture enough of that upside as we go, but in a really risk-focused way.
Definitely very interesting times at the moment. Now we have had a couple of questions, so I might flick back a couple of slides if you don't mind.
Sure.
Now I believe it was on this slide here. So we had a question going, essentially saying that the managed accounts have underperformed the managed fund over the longer terms. Why is that? Can we dig into that a little bit more?
So the managed accounts have only had a 7-year track record. I think they're both invested in very similar assets. It maybe just comes down to some implementation issues along the way via platforms and those sorts of things. I don't think that we're not trying to invest them significantly differently. I think it's probably just comes down to some implementations. We can be slightly more granular in the funds than we can in managed accounts, but the overarching exposures have always been quite well aligned.
Yeah, and just to add to that, because this is actually one of my advisors asking the question, so I'll be following up if I don't follow up now. Definitely, it just comes down to, as you're saying, comes down to that granular positions within the managed accounts. Obviously, we have to hold, we can only hold listed assets, and we have to hold certain percentages as well. So it just means that that underlying holding can be slightly different, and over the long term, in the short term, obviously they can play out slightly differently, but we don't, as you said, both have the exact same key themes. One doesn't typically outperform the other excessively. They all track quite closely together, and they all have their different periods of outperformance. So there's definitely no case of favouritism here, is there?
No.
Now, what else have we got here? So we've got another question from an advisor saying, wouldn't the fund have more latitude to manage liquidity and stock price targets when buying and selling?
Yeah, I think that the funds, we do have more opportunity to make sure that our portfolios are tailored to what we need. But as you said, Sam, I think that it's reasonably, it should be a marginal thing. I think that SMAs offer a whole range of benefits, funds offer other benefits, but in the end, the outcome should be very similar.
And I know as well we're quite creative in how we use the different vehicles to achieve what we want to achieve within the limitations of a managed account. So I remember only, and for those listening, you might remember this, but it was only a few years ago that when we first wanted to add a UK position into our managed account portfolio, and there just wasn't a listed UK ETF in Australia at all, which is quite mind-blowing at the time. Obviously there is now, so you have to be a little bit creative in using a combination of the ETFs or the managed funds to pick up that exposure that you want, or sometimes you might be happy just with the Europe ETF, which we were at that time. So it can result in slight differences, but the underlying themes, as you say, are always the same. Got another one here. Sorry, read it out loud and we can deal with it together.
Yeah.
So this one's from Gav. Aware of the tech somewhat bubble, they didn't have as big of a drawdown as the growth through return fund. Is this a red flag in your eyes?
Sorry, what?
Aware of the tech bubble, they didn't have as big of a drawdown as the growth through return flat. So essentially, the tech bubble didn't really draw down throughout this period, and didn't draw down, I think what Gav's implying, didn't draw down as much as the real return fund.
So I think that at the specific time in the markets, the tech, even the FANGs were down 30 odd %. I think the growth real return fund was down substantially less than that.
They did do quite well throughout the period, though. Obviously, with everyone,
that's right,
with the idea of everyone having to work from home.
Yeah. But the bounce back was also quite pronounced. But if you look at this slide, I think that you can see that we can get the exact numbers to you, but I think that if you look at just the FANGs, it was still a pretty large sell-off in March. It's just that the bounce back was very, very quick to bounce back.
I think these are the red flags in my eyes when I think about the FANGs. I know when you showed me this slide for the first time on Monday, I was very shocked to see what's actually being implied. I know we talk about it a lot, but it's great to see numbers on a graph around that.
That's right. And I think that, as we've said all along, it's different to the dot-com bubble. These are actually all established great companies, not just on a wing and a prayer, but they are getting very expensive.
Now, I am just conscious of time because I only have a minute left. Any parting words you'd like to say, Matt? Anything else you'd like to leave with us?
Just that we'll continue to invest in a risk-focused way. Invest in the areas that we think are going to give us the best long-term returns for all of our advisors' clients, and do the best to achieve our investors' goals over the long term.
And how, last question, given where we're sitting today, and you mentioned that we're pretty comfortable with hitting those long-term objectives of the portfolios. How are you and the investment team feeling at the moment?
I think that the key issue for us as an investment team at the moment is to make sure that we've got enough growth assets in the portfolio to achieve those objectives and in the right areas, and to really manage the risk and of a potential another sell-off and getting that balance right. I think it could be a bit more of a bumpy ride looking forward, given that we kind of trying to push in and potentially hold more growth assets than we were back in February, because there are still some opportunities, but balancing the risk of a sell-off in certain parts of the market is something that we're really cognizant of at this point in time.
I think that's a good summary. Thanks for joining us today, Matt, and for everyone on the line, as per usual, we will absolutely get a recording of this session out to you, along with a short video that Matt has also filmed that you can send out to your clients, just a summary, client-friendly version. I think it's only 2 or 3 minutes long, as well as a shortened version of this deck of scripted with scripts there as well, if I could talk. So you could go through these slides with your clients if you wish to do so. So on that note, we'll leave you all to your Wednesday. Have a great day, and we'll speak to you all soon. Thanks.
Thanks, everyone.